Okay, hello. Let's have a look at some income tax. So just a couple of caveats. This is a very basic example of income tax principles. I'm very aware before anybody gets upset, it doesn't include complex situations and it doesn't include things like national insurance. But I think what I would like to do is just explain how income tax works in principle, because some of us are getting a bit confused, and I think we think when we move into a higher rate tax bracket, it causes us a problem. So this is not about everybody's individual circumstances. You need to seek that out for yourself, but it's just to try and give you a basic overview of how the core principles work. Okay, so what you can see on the screen there is the current income tax thresholds that apply for England and Wales. Scotland, yours are a bit different, but it's the same principle. And the principle is that we work in thresholds. And what that means is that we only start paying tax or a certain percentage of tax when our income reaches a certain level. And we also only start paying that rate of tax on the income over that level. And I'm going to show you some very basic examples of that in a moment. But what we can see at the moment are the income tax rates that applied from last year and are still in place at the moment. It is important to understand that these thresholds can change with changes in government, or for example, when they do the spring budget and the autumn statement, they can change. But this is where we are currently. So normally somebody would have something called a personal allowance, and that means that any income up to £12,570 in a tax year would be tax-free. There would be no tax deducted. If you're a higher earner, this is slightly different. So remember, I'm just going on basic principles. And then if any income that you earn between 12,571 and 5270, pay 20% tax on, and income between 5271 up to 100-ish K, it's 40% tax. It does get a bit more complicated after that, but again, I'm just aiming this at very basic principles. So let me give you a couple of examples to show you what that means. Let's talk about Sue. So Sue has total taxable income in the tax year of £12,000. Now that is below this personal allowance of 12,570. So she will pay no tax on that, and her net income, therefore the amount she would receive, is £12,000. Okay. Let's have a look at another example for Sue. Let's say she now receives £25,000 of income. We know that anything up to 12,570, we will pay no tax on. But as we can see from our chart, anything over the 12,570 is taxable at 20%. So that means for an income of £25,000, the net income after we've deducted tax is 22,514. So we're only paying 20% tax on the bit from 12,570 up to the 25,000. Okay. So let's then look at a more complicated example. Sue now earns £60,000 a year. So what we know is that for the first 12,570, there is no tax to deduct. For any income then between 12,570 and 50,270, which is 37,500, the difference between these two numbers, we will pay 20% tax, which is 7,540. And then for any income over the 5270, which in this case is 9,730, we will pay 40% tax on, which is 3,892, which means Sue's net income after tax would be 48,568. Okay. Now, what's happening is that some people are saying through pay and pension, they don't want to be in the 40% tax brackets. There's a sticking point here, I think, with people where they get confused about what that means. So let's say you could be Sue and you could have your pay and your pension, which would be a total of £60,000. And therefore a net income after tax of 58,568. Again, just ignoring national insurance for the moment. If you are someone who doesn't want to take the pension or doesn't want to pay 40% tax, then you're effectively limiting your total income to 5270, because it's after that amount that we start paying 40% tax. So let's look at that. I don't want to be in the 40% bracket, which means we're automatically restricting our taxable earnings to 5270. We know that we will pay no tax on the 12,570. And we also know we will pay 20% tax on the next 37,700. The total then gets us to 5270. So when we take off that 20% tax, which is 7540, our net income after tax is 42,738. So because we don't want to go into the 40% tax bracket, our net income after tax is going to be restricted to 42,738. Whereas if we're happy, as Sue is here, to drift into the 40% bracket and take her full pension of 60,000, her net income is 48,568. So it's £6,000-ish a year higher, even with the 40%, because the 40% only applies to the bit over the £50,000. So will always end up with more net income than you would do if you restricted yourself to the 50,270. So that's just a really brief explanation as to how income tax and income tax thresholds work. There are legitimate reasons why you may not go into the 40% bracket. You can take action to save, such as additional pension savings, which might help you with income tax. We also, on earnings, need to factor in national insurance. I'm fully aware of all of those things. But somebody will jump on and be upset about it. But what I want you to understand from looking at the numbers is how the income tax thresholds work. So we shouldn't be trying to lead the conversation with I don't want to pay 40% tax necessarily. We need to make sure that we understand what it means for us and our position. Okay. So just something to think about. In the wider context of pensions, obviously it can need to consider when you're taking the pension, any early retirement deductions and various other things as well. But just on a case-by-case comparison basis, hopefully that will show you what it means by going into the 40% brackets. Okay, hopefully that's just giving you a bit of an insight, and maybe we'll come back and we'll do an update or a more detailed explanation at some point. All right, thanks everyone.